AMD is not Nvidia, and that's okay. The business wasn't built to be Nvidia. We just need to focus on the metrics that are most important for the business.
Happy Wednesday, everyone. Hope you're having a good week so far. Let's talk about AMD's earnings. And something that came up multiple times during the question and answer portion of the earnings call was AI spending. Microsoft also reported earnings earlier this week. So let's talk about that spending in light of what Microsoft said, as well as how AMD comes into play when we're talking about this AI spending. If you haven't had a chance to watch our video on AI spending, make sure you check it out. It's right here in the video, and we'll leave it in the description. It's a must watch. Before we jump into AMD's financials, let's talk briefly about what Microsoft said during their earnings call about capital expenditures.
Now, there was some more commentary about this, especially during the Q&A session, but we took this from CFO Amy Hood's prepared remarks, and this reinforces what we explained last week regarding all of these capital expenditures, that spending on property, plant, and equipment, or PP&E in this quote, not just for AI, but cloud computing infrastructure in general. So Microsoft reported $28.5 billion in its intelligent cloud segment, which was a 19% year-over-year increase. And the Azure cloud segment in particular grew 29% year-over-year. 8 percentage points of that growth came from AI services. And Amy Hood continued to explain that the CapEx in support of this segment, 19 billion, 13.9 billion of which was specifically the property and equipment to build data centers, is fully aligned with Microsoft's long-term demand from customers. Yes, for AI, but especially for cloud computing in general. When there's an AI customer that signs on for services, they're usually signing up for a lot more than just generative AI training or inference work. They need a lot of other cloud services as well. And so the CapEx, this is not a bubble, folks. This is a normal pace of CapEx in support of this very long-term secular trend that Microsoft and the other cloud giants are battling each other for. Doesn't mean it can't become a bubble at some point, but at this particular juncture, this is not even a debate. AI infrastructure is not a bubble at this time. Yes, spending is elevated a little bit, but this is just normal cyclicality to invest in data centers. We want to tell you about the Moomoo trading app and how you can get 20 free stocks if you are a new Moomoo user. So this is a chipstock investor exclusive for a limited time through the end of August 2024. If you open and fund a new account, you can get up to 20 free stocks, 5 of these exclusive rewards for the Chipstock Investor channel.
In addition to that, you get a couple of sweet bonuses to boot. Moomoo is offering 8.1% APY on your uninvested cash in the Cash Sweep program for the first 3 months, making sure that your cash continues to work for you while you look for those perfect buying opportunities for your portfolio. This interest on cash is free of management fees, and you can make deposits and withdrawals at any time. You also get a transfer in bonus of 1.5% cash back on your initial transfer, which is valued up to $300. Nick, what do you like about the Moomoo app?
Earnings season is upon us, and we like to make it easy by breaking it down week by week, company by company. It's helpful to have the right tools at your disposal when you're trying to parse through all of this company information. So directly within the Moomoo app, you can see individual dates of company financial reports. You can set alerts to receive notifications when your favorite companies are ready to release their earnings. And you can track your favorite stocks and see their financials and save and revisit these earnings calls for later use.
Moomoo offers 0 commission on stocks, options, and ETFs. There's no minimum deposit requirements, no account management fees, and no hidden costs. Get your 20 free stocks using our Chipstock Investor membership link.
Don't forget that limited time 8.1% APY for the first 3 months. This offer is good through August 31st, 2024. Take advantage of that. All of these rewards can be earned together, so don't miss out. If you're not a Moomoo user yet, sign up for an account today.
All of that spending in accelerated compute infrastructure translated into an increase in revenue for AMD in their data center segment. This is a comment from AMD's CEO, Lisa Su. She said that data center segment revenue increased 115% year over year to a record 2.8 billion, driven by the ramp of the Instinct MI300 GPU shipments and a strong double-digit percentage increase in EPYC CPU sales. She continues that cloud adoption remains strong as hyperscalers deploy those fourth generation EPYC CPUs to power more of their internal workloads and public instances. AMD also raised the GPU revenue guidance to exceed 4.5 billion in 2024, up from the 4 billion that they originally guided in April. And this really just emphasizes that this spending is on accelerated compute, data centers, enterprise computing. It's not just for AI.
Yeah, seriously, go check out the video we did last week on this. It's must-know information if you're an investor in chip stocks, and especially chip stocks that are very closely tied to the data center and AI market, which AMD has really been hanging its hat on. So, of course, AMD is a fabless chip designer. They don't handle any of their own manufacturing. They outsource that to companies like Taiwan Semi Manufacturing, and those chips get packaged up into computing systems like the MI300, and those get installed into data centers, customers like Microsoft Azure, Amazon AWS, and this has been an impressive growth segment for AMD. So historically, much like Intel, a lot of their revenue has been tied to the client segment, which is PCs and laptops. And we are getting a nice recovery finally in that client revenue segment. But you can see here in their overview, data center revenue, 115% year over year growth. That's pretty good stuff. However, let's peel back some of the hype like we have the last couple of quarters, Casey, and talk specifically about profit margins, because AMD is no Nvidia, unfortunately.
You can see that we have highlighted there that AMD increased 3 percentage points year over year to 49% in their gross margin. However, we'll take a look at a chart from Nvidia later that compares the two. Significant difference in profit margins between Nvidia and AMD.
Yeah, and to be clear, this is not just simply that Nvidia's AI systems are better or cost more money at this particular juncture. Again, as we've highlighted, AMD is an old business. It's been around for decades. It's well diversified, and some of those segments are still recovering from a very, very deep cyclical downturn. Client and gaming and embedded still very much in a downturn. And so data center growth is at this point more than offsetting the declines in those other segments. But the overall growth of 8% year over year is overall pretty lackluster. So a lot of investors have been hyper-focused on this AMD Instinct MI300 series of accelerators, or as the media has homed in on, AI infrastructure, but let's just call it what it is. It's actually just accelerators in general for enterprise computing and cloud. This has been the focus, but in all reality, AMD has a ton of work to do to get its operating profit margins fixed and in much better shape.
AMD has made some improvements. We can't forget that. The revenue in this last quarter, 5.8 billion, up 9% year over year, and that operating margin 5%, up 5 percentage points on a GAAP basis. On an adjusted basis, Q2 2024 operating margin 22%, up 2 percentage points. And in regards to this metric, it corresponds more closely to their free cash flow.
The main takeaway, though, is AMD's operating margins still have a long ways to go to justify the current valuation. And there are some good things going for AMD right now that will help. So you can see the operating income for the data center segment is now at a healthy rate. But because of that downturn that's still ongoing for especially gaming and embedded, those have been dragging down the higher margins. And of course, client, PC, and laptop now coming out of the downturn, but very, very meager profitability from the sale of those CPUs.
Now, Nick, that embedded portion is primarily from the Xilinx acquisition, the FPGA part of the business. Why is this slowing down?
The FPGA business tends to be pretty closely correlated to industrial markets, especially things like automotive, aerospace, industrial robotics, and automation. It's not an apples to apples comparison, but we have been addressing this over in our Discord channel and in our video yesterday on Semiconductor. On Semi does not make FPGAs, but the end markets do align relatively closely. So that embedded segment getting hit pretty hard right now because of a downturn in automotive and industrial chips. There's just too much inventory out there after a couple of years of chip shortage. And interestingly, it seems like the Xilinx acquisition, which was finally completed in February of 2022, it almost kind of was like some sort of elaborate retirement plan. The bulk of our AMD holding that we have actually came from Xilinx. And when Xilinx was acquired a couple of years ago, we just allowed that stock to convert into AMD, added that to our smaller AMD position. A big fan of co-founder and CEO Victor Peng, but he announced retirement. We'll have to keep an eye on this because recently Victor Peng was named president of AMD and was heading up the AI segment, including the ROCm software division that is helping AMD try to compete with what Nvidia does. So just a little side point here on that embedded segment. It's high profitability business, even in a downturn, but there is a management shakeup taking place. Just something to monitor.
Let's break these operating margins down a little bit further. Data center operating margin, 26%. Client operating margin, only 6%. Gaming, 12%. Embedded, that Xilinx portion of the business, at 40%. Q2 free cash flow was $439 million and a free cash flow margin of only 7.5%.
Yeah, again, a lot of improvement still needed. AMD, because overall it is not growing as quickly as the industry leader, Nvidia, or even Broadcom for that matter, we have been contending now since last year, AMD needs to fix its profit margins. This is the thesis. The AI and the accelerated computing growth story is great. AMD plays an important role in that part of the market. They need to grow that part of the business, but the profit margins are just not up to par. You can see a comparison here with Nvidia, which, yes, we understand is completely unfair. Nvidia's revenue is far higher, and so it benefits from the larger scale and thus the larger profitability that goes along with that.
Yeah, it seems a little cruel to compare the two. However, you can see gross margin in that most recent quarter for Nvidia was 78%, and on a GAAP basis, operating margin 65%. Now, we'll see in a couple of weeks how they fared in Q2, but no doubt it's a very similar story. Just huge profit margins.
And of course, I think a lot of people call AMD now the second fiddle to NVIDIA in accelerated computing. But that's actually not very accurate either, because Broadcom's networking segment, $3.8 billion in their latest quarter. A lot of that, of course, is networking chips, especially those networking chips that stitch together all of the GPUs, the accelerators, in a data center together to help coordinate their work on things like AI training, inference, or again, just accelerated compute for the cloud in general. As we've covered in past videos, embedded in that segment for Broadcom is the custom accelerator work that they are doing for companies like Google. Broadcom is quietly the company behind the scenes, enabling Google to design those TPUs, tensor processing units, that Apple recently said they used to train their AI models that are coming on the iPhone. So AMD is actually in third place if you really expand the view, not just to the logic chip part of the data center, but also the networking chip segment as well. Broadcom is the second place leader, and they also boast very, very high profit margins. Check out our latest video on Broadcom for a discussion of that. It's pretty wild. They've been doing this for a number of years now. It's not just a one-off effect from the AI boom or the so-called AI bubble.
Yeah, they absolutely know what they're doing. We briefly talked about the FPGA market. The embedded segment for AMD focuses on that auto and industrial segment. That's why there's a slowdown. But consumer market, which includes PCs, smartphones, and cloud and enterprise, it's just starting a new growth cycle. AI infrastructure, of course, and max growth. How will these two cycles help AMD?
Yeah, this is where they can start to make some real headway in their profit margins. If we look back again at the client segment, operating margin just 6%, and then gaming, very closely related to PCs and smartphones, more consumer facing products, only 12%. And then, of course, data center, it's not just the accelerated compute infrastructure, they have all the traditional cloud CPU based systems as well. As these markets heat up again and join the accelerated compute and AI infrastructure bull market, this should help lift AMD's overall profit margins higher. So this is good news if you're an AMD shareholder. The business is making solid progress, and it's going to get some help from market trends like this.
This chart on AMD goes back to 2022, and you can see that the stock has been pretty volatile. Xilinx acquired in 2022, the MI300X available the end of 2023, beginning of 2024. The stock has been volatile, but mostly sideways, really.
Yeah, if it's going to regain some upward momentum, we called this out in the previous 2 quarters. This is from the last update that we did in May. AMD CFO Jean Hu actually said that this was AMD's goal exactly, was to expand profit margins and drive operating model leverage as the business recovers in some segments and picks up market share in others, like in the accelerated compute industry. And at the time, we talked about how on a trailing basis, the stock appeared to be very expensive. This needs to be forward looking, given that the company is rebounding from that cyclical down. What we are looking for long term remains the same. We still think that for AMD's price to be justified and for the stock to continue to rise from, let's say, $150 a share is roughly where it's trading now in aftermarket hours following the Q2 update. We need to see mid to high 50% gross margin and high 20% to mid 30% free cash flow and operating margins by 2026. Based on the Q3 outlook, AMD continues to make steady progress in that direction.
Yes, absolutely. They are making some progress. On an adjusted basis, operating margin was 22% in Q2 2024. And then the Q3 guidance implies an adjusted operating margin of 25% at the midpoint of guidance. So a few percentage points increase expected in that Q3 outlook. So has the valuation for AMD changed?
It most certainly has. On a forward-looking basis, the stock is now trading in the mid-30 range on both a GAAP price to earnings basis and an adjusted price to free cash flow basis. That seems about right at this particular point. We still own AMD stock, but we're not planning on buying on this latest dip. We think the progress that the business is making merely justifies the current valuation as the stock has kind of risen from the depths of the bear market over the last year and a half or so. But more work needs to be done to justify higher prices from here. So yes, the valuation is improving. Again, just to emphasize this point, AMD is not Nvidia, and that's okay. The business wasn't built to be Nvidia. We just need to focus on the metrics that are most important for the business, and those are the profit margins. They're making good progress on that front. We're happy to just hold what we have at this point.
Make sure you check out our link below to get 20 free stocks from Mumu as a new user. We also have a link to a FinChat membership that gets you 15% off. During this video, you didn't have to watch a single ad because of these two promos, Mumu and FinChat.
with the exception, of course, big YouTube's 5-second pre-roll ad. Hopefully that didn't take too much of your time. And the Moomoo promo, check that out. It's a pretty generous offer.
We'll see you again very soon at Chipstock Investor.